So we will continue from the questions that we skipped. The question number 4, actually I skipped in the earlier video. So I'll quickly do that because that's the only remaining question out of the 10-mark questions. And there are 3 more questions that carry 25 marks, where 2 of them are like, 2 of them are into kind of 2 out of 3 you need to select. 2 out of 3 you need to select. So, but we will work out all 3 so that you get an exposure for all 3 different areas. So, at the exam, you have a choice. Section A, 5 questions are compulsory, as I told you before. Section B, 3 questions, answer any 2 questions. That's what it says. So, we start off with the only remaining question out of section A, which is question number 4. So you are the corporate management accountant at Island Food Private Limited, not Private Limited, Island Foods Limited, IFL, a fast-growing food processing company that has recently expanded its operations to multiple regions. They have expanded their operations. The company currently uses standard costing to control production costs, set pricing, and measures performance. So this is important. They are using standard costing to control production costs, set pricing, and measure performance. Right? The standard costing method is being used. Recently, the operations team has reported frequent variances between actual and standard costs due to volatile raw material prices. So variances, we know whenever there are standard costing, we will have an actual cost as well. So you compare those two, there are variances. Variance analysis we learn from the small days for that purpose. Now, frequent variances are there, okay, between actual and standard cost due to volatile raw material prices, frequent menu changes, and fluctuations in labor efficiency, right? So these 3 are there, kind of affecting what we are going to do, right? So these 3 are there as main reasons for the variances between actual and standard cost. Volatile raw material prices are changing. Venas raw material prices, sulu prices තියෙන්නේ. Frequent menu changes. This is a food processing company, they say. Fast growing food processing company, menus venas වෙනවා. Frequent menu changes and fluctuations in labor efficiency. Labor efficiency, how quickly we can process this food. Laborers efficiency, that's also fluctuates. In Sinhala, you say uchchavachane vena, going up and down, fluctuations. Senior management of IFL has expressed concern that the current focus on meeting cost standards may be affecting staff morale. Current focus on meeting cost standards may be affecting staff morale, leading to shortcuts in production processes and increased stress among line workers. Staff morale, motivation and morale are 2 different things. Morale kiyanne in Sinhala like gammak tiyenawa kiyala kiyanne, like, okay, they are willing to do the work, or they are quite motivated, they are quite passionate on what they do. Now that is coming down. It might affect, leading to shortcuts in production processes. So if they want to show some efficiency, they might look at shortcuts in production processes. And increased stress among line workers. So like they want to show their performance, or they want to make sure that they are buying at the correct price, or they want to make sure that their efficiency levels are higher, right? So with that, they might be in a stress situation, right? Stress එක වැඩි තත්ත්වයක ඉන්න පුළුවන්. Additionally, the company is adopting practices inspired by McDonaldization. Now, I will explain McDonaldization separately, right? Because this is quite important. the concept of McDonaldization, you need to know. Yeah. So let me explain that a little bit. Now, what it says is, additionally, the company is adopting practices inspired by McDonaldization, aiming the efficiency, predictability, and control across all outlets. Aiming, you can get some idea even if you don't know what is McDonaldization, you can get some idea. Aiming for efficiency, predictability, and control across all outlets. While the standardization improves operational consistency, it may have unintended behavioral and ethical implications. It may have unintended behavioral and ethical implications. Right? Yeah, so let me explain the McDonaldization a little bit. Okay, some additional note with regard to the pilot paper question number 4. Okay, pilot paper question number 4 regarding McDonaldization. McDonaldization. Kind of an additional note for your knowledge purpose. Right? Now, this is about a sociological concept by George Ritzer, somebody called George Ritzer. George Ritzer has come up with, because McDonald's is a kind of a franchise chain that is world popular, unfortunately no longer in Sri Lanka, but it was there until recently. How the principles of the fast food industry, efficiency, calculatability, predictability, and control have come to dominate nearly every aspect of modern society, from education and healthcare to retail and entertainment. Right? This is a sociological concept. Sociological concept. Sociological concept. Sociological concept by George Ritzer, describing how the principles of fast food industry is applicable for fast food industry. Describing how the principles of fast food industry principles of fast food industry such as efficiency, how the principles of fast food industry such as efficiency, calculatability, predictability, out of which they are talking about three things here: efficiency, predictability, and control, right? Such as efficiency, predictability, calculatability, and control. Efficiency, calculatability, predictability, and control. Have come to dominate nearly every aspect of modern society. Have come to dominate nearly every aspect of human life, starting from education to things like healthcare, retail, entertainment, everything. Right? So this phenomenon actually explains how society increasingly values the speed of delivery. Because McDonald's is famous, like, their delivery is super fast. Standardization and quantitative measurements over personalized human experience and quality, right? This phenomenon, McDonaldization, this phenomenon explained how society increasingly values speed. How the society increasingly values speed. Okay, speed is one aspect. Standardization. McRice is same everywhere. Okay, McDonald's, the burger that you get is same everywhere. That's the standardization, the franchising requirement, right? And quantitative measurements. Quantitative measurements over personalized human experience and quality. I mean, they became more powerful. Speed, standardization, and quantitative measurements over personalized human experience and quality. Human experiences and quality. Just for your understanding, I'm giving this, but by any chance, if this is like just you get a slight question about McDonaldization like this, since they are the pilot paper, I don't know whether it will come or not, but there's a possibility, right? So there are four core dimensions. Four core dimensions are there under McDonaldization. Four core dimensions. Number one. Right? So there are four core dimensions. Number one, efficiency. what we mentioned earlier. Efficiency, you know what is efficiency? Output versus input of the workers. Finding the optimal, quickest way to get the point A to point B. Example, by drive-thrus, by automated checkouts, self-checkouts, or prepaid packaged meals. So McDonald's, what they used was something like that, right? Okay. Then calculatability. Second four dimension is calculatability. Calculatability. You are able to calculate. What do you mean by calculatability? Emphasizing quantity and speed over quality. Emphasizing quantity and speed over quality. Emphasizing quantity and speed over quality. Right? So on that aspect, yeah, so it's like more than the quality, the speed and the quantity, how quickly you get, be it an ice cream, be it mac rice, be it the burger, whatever you order there. I mean, that has gone up to that side of standardization, same level of quality they expect. They are not worried about the quality, they are worried about getting it quickly and getting it like um, speed and the quantity, how quickly they get that, right? Then predictability. So this is like speed and quantity over quality, right? Speed and quantity, ප්‍රමාණය. වේගය සහ ප්‍රමාණය quality එකට වැඩිය බලනවා. But under quality management, total quality management, we are talking about a different aspect, right? So this is another management concept we are talking about. A sociological concept by George Ritzer, McDonaldization, right? So calculatability is basically speed and quantity over quality. Then the next one is predictability. 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 Predictability is ensuring that the products and services are identical, same. Mac toy is the same. Mac the French fries you get is the same always, right? So products and services are identical no matter where in the world you are. The Big Mac tastes in Colombo or Ambalapitiya or maybe Kandy or maybe Nugegoda, Anuradhapura, wherever it was. Now it's not there, unfortunately. And McDonald's in New York have to taste the same, right? Taste the same. Products and services are identical. Products and services standardized, right? Identical. Identical irrespective of the branch or the location. The branch or the location. Product and services are identical. We expect that. That's sort of a standardization. McDonaldization, one of the key concepts. And control, utilizing technology to strictly standardize the rules to control both the employees and the customer. Controls. Right? Fourth dimension is control. So please remember, these are the four key things: efficiency, calculability, predictability, and control. In the sum, they have given only the number 1, 3, and 4. Calculability, they have not spoken much there. But if you know that, you can use it if you are answering a theory question. Utilizing technology to strictly standardize the rules to control both employees and customers. Employees follow rigid script. The automated machines dictate the pace of work. Right? Using technology to Technology and strictly standardized rules. Technology and strictly standardized rules. And strictly standardized rules to control both customers and employees. Control employees and customers. Strict menus given, strict rigid scripts are given. That is how you need to follow. Automated machines are there to bake certain things, fry certain things and all like that. So efficiency is finding the optimal quickest way to get from point A to point B. This is optimal quickest way. Finding optimal quickest way to get from point A to point B. Point A to point B. Examples: drive-through concept, quickly you deliver it. Prepaid packages, meal packages readily available. Prepackaged meals and automated self-checkout. You just pay on your own and go just punch in the card or something and get the payment done. So there's no requirement of a cashier or anything. Those are called McDonaldizations, right? Now I'll come back to the sum. This is some additional note I gave you for you to understand this concept since they have tested it here, right? So additionally, the company is adapting practices inspired by McDonaldization, aiming for efficiency, predictability, and control across all outlets. While this standardized, so this particular food company is also talking about this standardization under McDonaldization, right? While this standardization improves operational consistency, it may have unintended behavioral ethical implications. Okay, it may have improved the operational consistency, yes, but it may have unintended behavioral and ethical implications. Unintended behavioral and ethical implications can be there. Following information is provided. Following information is provided. Okay, following information is provided. The standard cost of tea leaves. Standard cost of tea leaves. The main raw ingredient used in production. The main raw ingredient used in production was set at rupees 550 per kilogram at the beginning of the year. During the period, adverse climate conditions led a significant surge in the market prices. So the standard cost for tea leaves, main raw material ingredient in the production, the tea leaves is the main raw material in this production, whatever the production they're talking about. 550, the standard cost for tea leaves, right? However, during the period, adverse climate conditions led to a significant surge in the market prices. In January 2026, the company purchased 1,000 kilograms of tea leaves for 650,000. So 650,000 divided by 1,000 per kilogram, you get 650. Standard price was 550. Actual price has been 650. Production for the month used 950 kg. Used quantity 950 kg for tea leaves. So if you are going to calculate variances, purchased quantity is required for price variances. Used quantity may be required for usage variance. So we need to remember the fundamentals. Explain 3 behavioral issues that may arise at IFL from using standard costing in a rapidly changing environment. Explain 3 behavioral issues that may arise at IFL from using standard costing in a rapidly changing environment. 3 behavioral issues that may arise at IFL from using standard costing in a rapidly changing environment. Now we say standard costing had been a kind of traditional, it has been like heart of management accounting, I would say. I mean, without talking about standard costing and variance analysis, there is no cost accounting or management accounting. But nowadays, things are rapidly changing. We are talking about short-term risk management. The things are changing rapidly. Can you further standardize a price or a cost for a period of 1 year or even 3 months? Is a question mark, right? So we saw what happened during the Middle East wartime, like the fuel prices hiked. So once you say there's a news that okay, Hormuz Strait is going to get open, or some ceasefire agreement is being signed, or whatever, the prices come down. So fluctuations, can you standardize something like oil price, or if you are purchasing oil for as the raw material for some production, right? Can you apply standard costing in a situation like that? So there are behavioral issues. So I'll take you all through. They're asking 3. The key word is explain. Explain is the key word. The bold letter words are very important. Explain, discuss, state, right? So that you need to like explain. So this is more into theory, even though it's standard costing and variance analysis, it's more into theory. Right, so we'll try to answer for this question. Okay, going back to the sum. So now still we are in the question number 4, part A, behavioral issues. Behavioral issues. Behavioral issues. Behavioral issues. Okay. Right. Now, one behavioral issue, now already there were few mentioned here. We have already underlined them if you look at, right? We have already underlined them if you look at. Now, why we underline or highlight is that you don't have to read the question again and again. We already have highlighted those. Now, one thing is that unintended behavioral ethical implications. Now, meeting cost standard might be affecting staff morale, leading into shortcuts in production. Actually, I forgot to underline that, and increased stress among line workers. So this is one aspect. Shortcuts in production processes and increased stress among line workers. Increased stress among line workers, right? So one pressure is the pressure to meet standards, right? So it was mentioned somewhere, right? So continuous set pricing, volatile round, frequent and fluctuation in labor efficiency. I have expressed concern that the current focus on meeting cost standards may be affecting staff morale, leading to shortcuts in production process and increased stress among line workers. Right. Additionally, the company is adopting practices inspired by McDonaldization, aiming for efficiency, predictability, and control. While these standards improve operational consistency, it may have unintended behavioral and ethical implications. So we are going to talk about them. Right. So there is pressure to meet standard. Right. Their morale already mentioned here. Staff morale can come down. Right. They are focusing on a very short-term gain. Okay, they want to like maybe do a malpractice even and show a higher efficiency, shortcuts in production processes and get it done. But long run, it won't sustain. Resistance to change and gaming the system, like sometimes manipulating the system. Okay, these are 5 things. So we need to write down 3. Pressure to meet standards. pressure to meet standards. Okay, one aspect is pressure to meet standards. Okay, so at IFL, this company, what's the name of the company? In Island Foods Limited, they may be focusing on achieving cost and efficiency targets rather than overall quality and innovations, what I explained in McDonaldization, right? Achieving cost and efficiency. So we already wrote this part. This is on McDonaldization. Speed and cost and efficiency rather than overall quality and innovation. Employees focusing on cost and efficiency. Speed and quantity also similar, right? But cost, it's about the cost and efficiency. Targets. Output versus input. Efficiency means output versus input. Efficiency is always output divided by input. So you want more output from a given input. Higher efficiency. Or maybe within a short time. Right? Productivity also similar, but within a short time you need to do that. Targets rather than overall quality and innovation. Rather than overall quality or innovation. Overall quality or innovation. Okay? Right. Number 2, reduced morale. It affects the staff morale. No? Reduced staff morale. What do you mean by morale? Right, I already explained, but let me come up with a kind of a proper definition for that. Morale means the overall mental, emotional, and psychological state of a person or a group of persons. Mental, psychological, and emotional state of a person of one or more people, particularly their level of confidence, enthusiasm, and cheerfulness in facing a task. Okay, or even a hardship, like how cheerfully, how happily, how confidently, how enthusiastically they are facing a challenge is the morale, right? Okay, so reduced morale now, even if they have challenges, even if they have difficulties, even if they have targets or goals given, if they are not cheerful, if they are not motivated, if they are not enthusiastic, right? So reduced morale. Frequent variances and unrealistic standards can demotivate staff, particularly when standards do not reflect current operational reality. So standard is hypothetical and the actual reality is quite different, because it says now, due to bad weather conditions that we had, we are not in a position to buy at 550, it has gone up to 650. So you will never hit the material price variance positive. Right, so that's a problem. Or even usage variance it can affect. Definitely the price variance is going to be a problem, right? So I mean, the even in standards we talk about, so this is something additional. Even in standards we talk about different types of standards, right? If you have looked at my video on standard costing, right? We are talking about basic standards, very basics, everyone can achieve it, right? Then kind of ideal standards, you never achieve them. In an ideal situation, hypothetical situation, you can achieve. Always the actual variance will be negative, but If it is slightly negative, you may still call it a great achievement. You give a target of 100, 100 is never achievable, but you reach 85, 91 is a good mark. But you will never go beyond 100, right? Attainable standard, this is what we recommend. Attainable standard, like it's not easy to achieve, but achievable, and even if you can go beyond, right? So, I mean, it's not easy, but can do. And current standards. Current standards are what we are doing now. Like if we can buy at 650, we say, okay, that should be the standard. No, that's also not, then again, easily you can achieve. So this is the most recommended one. But in McDonaldization, I think we are going for something like this ideal standard, where it's very difficult to achieve. So when you always can't achieve the standard, or standard is unrealistic, the staff morale can come down. So that's what it says. It's a disadvantage of ideal standard as well. It's a disadvantage of ideal standard as well. Okay. Reduce staff morale. Right? Frequently changing, frequent variances, we'll say. Frequently varying, or frequent variances, shall we say? Frequent variances, and unrealistic standards. This is very important. Unrealistic or ideal standards, right? These are not practically achievable. Unrealistic standards can demotivate your staff. Can demotivate your staff. Can demotivate the staff. Right? So, particularly when the standards do not reflect current operational realities. Then the third one, I'll erase this part. This was some additional note I gave you, right? Short-term focus. Short-term focus. Workers and managers of IFL may prioritize actions that improve variance reports rather than long-term efficiency or customer satisfaction. You try to manipulate, or you try to do something short-term, the efficiency is improved, right? Try to avoid the variance reports rather than focusing on long-term efficiency or customer satisfaction. Employees and managers focusing on improving variance reports. Somehow you try to get rid of the variance rather than long-term efficiency or customer satisfaction. Long-term efficiency or customer satisfaction, right? Resistance to change is always there. We have already spoken about this in another situation also. ESG framework also I mentioned about it. Resistance to change. Always employee resistance can come. Resistance to change. Resistance to change. IFL's use of standard costing system can create inertia, making employees, you don't need to use these higher words, right? Simply you can explain making employees reluctant to adopt new processes, technologies, or flexible practices needed in a dynamic and so they want to follow the standardization, they want to follow the McDonaldization, they want to follow the rigid systems dictated upon them. They're not going for innovation, they're not going for flexible operations, they're not going for any dynamic approaches, new processes, right? Okay, we'll say like this. McDonaldization, McDonaldization, and application of standard costing. McDonaldization and application of standard costing. Standard costing. Okay. Application of standard costing. McDonaldization and application of standard costing. Will limit, I'm giving it in a simple form, innovation, flexible processes, because all the processes are standardized, no? Flexible processes, flexible practices, I would say, new processes, flexible practices, new processes, and use of new technology. I mean, it can come, technology won't be brought in by McDonald's station, but not in the way that the employees want to do, not in a way that their research and development would say. Right? Okay, I mean, it's always standardized, highly rigid environment. Controlled, employees and customers both are controlled through technology and rigid processes. It's a bad part of McDonaldization, right? Then last one is given as gaming the system, manipulation of input usage or reporting to appear compliant with standards, reducing reliability on performance measure. Manipulation, gaming the system or manipulation. Gaming the system or manipulation. Manipulating input, manipulating kind of input usage, uh, altering, changing or altering reporting to appear complying with standards. බොරුවට අපි පෙන්නනවා standards වලට comply වෙනවා කියලා. That's a manipulation. Okay? So that's not a good reliable performance measurement. Right? Reliability of is A, reliability of performance measurement is not there. Okay, right. So part B of the question, if you look at, discuss ethical issues that may arise among staff in a highly controlled operational environment using the material price variance for tea for the month of Jan 2026 with necessary computation. You discuss the ethical issues. Now, behavioral issues and ethical issues, both they are talking about, right? Under behavioral and ethical implications. Discuss ethical issues that may arise among staff in a highly controlled operational environment using the material price variance for tea for the month of Jan 2026 with necessary computation. So we can show the material price variance there because actual price that we are buying is 650,000 divided by 1000. Okay, right. So there's a material price variance coming in. And usage variance, I don't know whether you can calculate. There's no point in calculating. We can calculate that. Yeah. Right. Part B. We will calculate, okay, actual price per kilogram of tea leaf would be rupees 650,000 divided by 1000, that is rupees 650. Rupees 650. So we can get the material price variance. Now by this time you should know all these formulae, right? Standard price minus actual price. Standard price minus actual price into actual quantity of purchase, because actual quantity of purchase is given as 1000, per production for the month use 900, actual usage is 950 kilograms. Okay, right. So the actual quantity is 1000, standard price is 550, actual price is 650. 1000 multiplied by minus 100, rupees 100,000 is the variance, that is adverse. Adverse variance is available, rupees 100,000. Okay. Now actual price is 650 kilograms per kilogram, higher than the standard price, especially in a highly controlled environment. There can be ethical issues, right? So what are the ethical issues through this with the supporting calculation? We can go for the usage variance also, then actual quantity of purchase. I mean, then you should know what's the standard quantity of usage, budgeted quantity, like the standard quantity for the actual production or something, but that's not given, so we can't calculate that, right? It's not just the actual purchase quantity, you need the standard quantity for actual production. That's not given here. Okay. So price variance, you get an idea. So we are anyway ending up with an adverse price variance. This is affecting their morale as well, because their standard price is now unrealistic. Okay. Now here, what are the ethical issues that you can get? Now, earlier we talked about behavioral issues. Right? Behavioral issues like, okay, manipulation is the last one, short-term focus, resistance to change, pressure to meet the standard, reduce staff morale, right? Now, with that ethical issues coming up, you might go for compromisation of quality because McDonaldization focuses on speed and quantity rather than the quality. So, compromised product or service quality. Compromised, not totally reduced, but reduced to some extent. Compromised up to some level, not 100%. It has come down to maybe 60%, 70%, 50%, somewhere there. Compromised product or service quality. Product or service quality. Okay. So more focus on efficiency, predictability, and control may lead to cutting corners, risking customer safety or satisfaction. Even grade tea leaves of 650 per kilogram is highly graded despite the significant surge in the market price resulting adverse climate conditions. So higher price, no, highly graded, right? So here like emphasis on McDonaldization, emphasis on McDonaldization within brackets, efficiency, what is given in the sum, predictability, calculatability was not given in the sum, I am putting it, and control, 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 may lead to poor quality. May lead to poor quality food products. You are not bothered about the quality now. Food products. Risking customer satisfaction. Risking both the customer safety, hygienic concerns and all can be there. Food item එකක් කිව්වහම සනීප ආරක්ෂකතාවය තියෙන්න ඕනේ. Satisfaction. Food products risking customer safety or satisfaction, right? And can even go for grading the 650 leaves as a higher grade. And misguiding customers that tea leaves bought at 650 because not because of higher quality, because of adverse weather condition, the tea leaf price has gone up. Tea leaves bought at 650 rupees, 650 are higher graded tea. Higher graded tea. Higher graded tea. Okay. Right. So then we are going on for employee exploitation can come. Standardized performance targets combined with cost pressure can increase stress and lead to unfair workload. Stress and unfair workload, employee exploitation. Employee exploitation. Stress and unfair workload on employees. Misreporting and manipulation, even earlier gaming the system, we pressure to meet standard of 650 may encourage false reporting and production output based on time block. Misreporting and manipulation, it's under behavioral issues also. Misreporting and manipulation, I'm not going to explain it in detail because you adjust to bring the standard cost at 550 per kilogram. You might adjust the actual outputs or whatever in the reports. Reporting production output wastage or time block. False reporting of production output wastage and even time logs for efficiency purpose. Manipulation, wastage, and time logs. Manipulating efficiency. Manipulating efficiency of the processors and employee efficiency. Right? Conflict of values. Employees, because they're asking for 4 marks given, at least 4 we'll have to write down. Employees may face ethical dilemmas between following strict operational standards and acting responsibility or safely. Conflict of values. Conflict of interest come for investors, owners, top management, and all this conflict of values. Ethical dilemma between uhato kotika prashnya, big problem. Ethical dilemma between strict operational standards and acting responsibility. Strict operational standards, McDonaldization, that is there, no? Operational standards versus acting responsibly or safely, like hygienic concerns and everything, quality levels going up. So that's responsible acting. And reduced accountability, right? For rigid focus on metrics may shift responsibility from decision makers to frontline staff, undermining ethical decision making. Accountability can go down. Reduced accountability. Reduced accountability. Rigid focus on metrics. Rigid focus on metrics Or we'll just say without telling that. Because of rigid processes, delegation of decision making to the front line, like operative levels, that is a reduced accountability. To front line undermining ethical decision making, undermining ethical decision making. Reduced accountability, reduced accountability, rigid focus on metrics, rigid focus on metrics, or we'll just say without telling that. Because of rigid processes, delegation of decision making to the front line, like operative levels, that is a reduced accountability. To front line undermining ethical decision making, undermining ethical decision making. So I took a bit more time and explained this, even though it's a 10-mark question, because you need to understand the concept of McDonaldization, the concept of standardization, and ethical and behavioral issues that can arise from that. Part C, as the management accountant of IFL state, the ways in which you could mitigate behavioral and ethical risks while still using the standard costing for performance management and control. Right? State the ways in which state the ways in which you could mitigate behavioral and ethical risks while still using standard costing for performance management and control. Right. State the ways in which you could mitigate behavioral and ethical risks. As the management accountant of IFS, state the ways in which you could mitigate behavioral and ethical risks while still using standard costing for performance management and control. Now, we talked about the behavioral issues, we talked about the ethical issues, how you can mitigate those behavioral and ethical risks. So, one thing is that the standard that we are setting has to be realistic and attainable, setting attainable standards, realistic and flexible standards, right? Inappropriate quality performance measurement, incorporate qualitative performance measurements like combining standard costing with metrics for quality, customer satisfaction, innovation, like the balance scorecard, getting something like balance scorecard. Promote ethical culture, right? You train your employees and managers to follow ethical standards, come up with higher values, respect, integrity, and excellence, and all these kind of values. Integrity is a concern. Emphasizing the manipulation and all are not good. So the quality and safety are priorities. Ensuring customer safety, customer satisfaction, and the quality of the product or service is priority. Encourage participation. Employee participation in setting standards is very much important. Like get their inputs also. Like it's like bottom-up budgeting kind of concept is important. Improve buy-in and reduce resistance. Okay. Balanced reporting. Use variance analysis as a learning tool rather than a punitive measure. Like if you get an adverse variance, it should not be a punishment always. It's a learning tool. How you can further improve. Encouraging continuous improvement, Kaizen. Periodic review, time to time you review rather than waiting till the end of the year, end of the period, time to time review so that you can adjust, align operating practices inspired by McDonaldization with organization values to prevent excessive rigidity or harm. Like time to time you review whether these are too rigid or not. So we can put like 3 marks to state the ways. Like, okay, 3 is even enough, but we'll give a bit more than that, right? State. Okay. This is like mitigating behavioral and ethical risk. Mitigating behavioral and ethical risks. Set attainable, realistic, and flexible standards. That is number 1. Key point. Okay. Number 2, incorporate qualitative performance measures. Incorporate qualitative performance measures, KPIs. Example, balance scorecard. BSc stands for balance scorecard, like customer satisfaction, customer oriented, quality, then customer satisfaction, quality, innovation or internal business processes, so on, right? So that's another aspect that we are looking at. Right? Promoting ethical culture. Promoting ethical culture. Under that you get training, managers, managers and employees, not to managers and employees on ethical standards, ethical standards such as integrity, so that no manipulation of KPIs happen, no manipulations in reporting happens, no manipulation of reporting happens, no manipulation of reporting happens, and focuses on quality, focuses on quality and safety, customer safety, product quality. Just say quality and safety to reduce the number of, just they state, no need to write down paragraphs. So even 3 is enough. I'll give the other ones also. Balanced reporting is also linked to this. No manipulated reporting. Balanced reporting. Okay, on that. Variance analysis is a tool. Variance analysis is a tool. Variance analysis is a tool rather than punitive, punishing KPI, right? Not a punishing KPI. Okay. And encouraging continuous improvement. Encourage Kaizen. Encourage Kaizen, I'll say in short form. Kaizen is continuous improvement. Kaizen. You know that by now. Continuous improvement. Employee participation in setting standards and periodic review. Employee participation in setting standards employee participation in setting standards so that they are moralized. I mean, they don't lose the morale. They don't reduce. I mean, their morale is up, morale is high, and resistance is reduced. Employee resistance is reduced. Periodic review of standards, the McDonaldization, whether they are realistic and matching the reality, or like whether they are realistic and whether there's excessive rigidity or something. Excessive rigidity, etc. So you write down 3 out of that is more than enough. So I took a bit more time and explained the entire concept of McDonaldization how it can be applied in this standard costing and variance analysis scenario. So this is sorry. So this is what was tested, right? Okay, we'll move on to another question. Section B, the first question, question number 6 is on working capital management. We already discussed about working capital management, so we will go through that. XYZ Manufacturing PLC, XYZ is a leading manufacturer of biscuits in Sri Lanka, supplying both domestic and regional markets. The company prides itself on high product availability and superior customer service. Company prides itself on, they are proud, ආඩම්බරයි ඒගොල්ලෝ, high product availability and superior customer service, which has allowed to maintain a premium market position. Because of that, they have a premium market position. Their customer service is good and high product availability. Like, okay, so this is contrast to McDonaldization example that we talk about, right? Previously, what we talked about, the McDonaldization example, compared to that, this is completely the opposite. We just allowed it to maintain a premium market position. However, senior management, senior management, they have secured a premium market position. However, senior management has raised concerns about rising working capital requirements, which are tying up cash that would otherwise be used for strategic investment in R&D and market expansion. So, rising working capital requirements is a concern for the management, the senior management, because their cash is tied up. Money hira vela thiyene me working capital requirement එක, otherwise would have been used for strategic investments in R&D or market expansion. So, ඒකට කරගන්න තියෙන සල්ලි working capital requirement එක හින්දා හිර වෙලා තියෙනවා. Money is tied up in the working capital requirement. For the year ended 31st of December 2025, the company's financial and operational data are as follows. It says revenue 100% on credit basis, 2,400 in rupees millions. In rupees millions given 2,400. Cost of goods sold 1,440. Average inventory 280. Average trade receivables 360. Average trade payables 210. Cash and cash equivalents 60. Annual operating expenses excluding cost of goods sold 360. Additional operational information, the company operates 360 days per year. So your calculation is going to be easier. The company operates 360 days a year, because otherwise you will have to assume 365. So they are telling it, so no problem. Cost of capital is given 12% per annum. At the request of the senior management, the following initiative, at the request of the senior management, the following initiatives are to be evaluated to improve working capital efficiency. Okay, while recognizing the trade-offs, between liquidity, service level, and supply chain relationships. Improve working capital efficiency while recognizing the trade-offs between liquidity, service level, and supply chain relationships. Reduce inventory holding period by 20 days. So they are planning to, like, inventories being held at the moment, part of working capital. We know working capital includes the inventory, the current assets minus current liabilities. So current assets, inventory, debtors, and cash mainly. current liabilities, mainly the trade payables and any other payables. So reduce the inventory holding by 20 days, improve receivable collection by strengthening credit monitoring, improve receivable collection by strengthening credit monitoring. Additionally, uh, additionally, to offer a 2% early settlement discount to all the customers who pay within 30 days. If the customers pay within 30 days, 2% early settlement. So you can bring down your debtor balances in one way. It is estimated that 60% of the customers will take up this option. Okay. Negotiate supply credit extension to 90 days to reduce immediate cash outflow. So this traditional working capital uh, uh, kind of like the approach we are looking at. Supplier credit period extending, delay your creditors payables as much as possible. That rule they are bringing to 90 days to reduce the immediate cash outflows. Not the strategic working capital, but the conventional working capital techniques they have given. Management expects these measures to improve working capital efficiency, but is concerned that overly aggressive attempts could adversely affect operational performance or relationships with key stakeholders. A balance must be maintained between minimizing cash tied up in operations. Okay, now the management expects these measures to improve working capital efficiency, but is concerned that overly aggressive attempts could adversely affect operational. Right, these measures are like will improve working capital efficiency, but overly aggressive attempts could adversely affect operational performance. If they go on very much aggression on that, it can affect the overall performance as well, or relationships with key stakeholders. Okay. A balance must be maintained between minimizing cash tied up in operations and preserving the company's differentiation strategy. A balance must be maintained between minimizing cash tied up in operations and preserving company's differentiation strategy. Let's see. Why? Which relies on high product availability and strong supplier partnership. Now, this is very, very important. Strong supplier partnership. Now, for you to have a strong supplier partnership, this is on strategic working capital management. Can you ask your suppliers to wait 90 days all the time and you delay your payables as much as possible? It may not work always. It may not work always because they may not be happy. Like you want to reduce your debtor balance, you want to get the cash quickly, you give discounts and all. They may be also thinking about us like that because we are the customers for them, right? So that balance must be preserved, which relies on high product availability and strong supply partnerships. You are working as the management accountant of XYZ and your boss has asked you to support him uh, by performing the required analysis and providing the following information. Conduct a preliminary assessment of the current status of working capital management, including the calculation of appropriate working capital efficiency measures. So we'll see how we do this preliminary assessment. So we will see how the preliminary assessment will be conducted on this aspect, right? Okay. Yeah. Now you are given certain information. This table particularly is going to be vital, right? The table particularly is going to be vital because that carries a lot of information here, the data required for our sum. Right. So we are given the revenue totally on credit basis, and the cost of goods sold is given. Then average inventory is given, average trade receivables, average debtors is given, average trade payables, average creditors is given, cash and cash equivalent, and annual operating expenses excluding cost of goods sold is also given. Right, so with that, what sort of like we can do certain ratio analysis, the inventory turnover ratio and number of days, daily inventory outstanding, days inventory outstanding, days sales outstanding. The new terms we'll have to get used to a little bit. Days payable outstanding, operating cycle, cash conversion cycle. These are some of the things that we can find out. Now, inventory number of days or days like inventory outstanding. Okay, right. Right. So this is on question number 6. DIS or days inventory outstanding. In other words, inventory days. Simple terms. Good old days we were used to call it inventory days. So how do you calculate that? How do you calculate that? The average inventory divided by cost of goods sold. Right? Average inventory divided by cost of goods sold multiplied by 360 days. Average inventory. Now you don't have to follow the same format given in the suggested answers, right? You can have your own method as long as the answer is correct. You'll be given marks. Average inventory divided by cost of goods sold. Cost of goods sold into 360, you are getting in terms of days. Okay, 360 you are getting in terms of days. Right. Okay. Right. Yeah, so 280 divided by 1440. 1440 multiplied by 100. Right? 280 divided by 1440. Sorry, not multiplied by 100. It's 360 days. It's not the inventory times, no. Right? So 280 divided by 1440 into 360. 70 days. 70 days. Right? Okay, we'll go on for another one. Days of receivables, sales outstanding or receivable period, DSO, days, sales outstanding. DSO. DSO, in other words, is days sales outstanding. I'll divide the board into two parts. In other words, we call it as debtors collection period. Debtors collection period. Inventory days or inventory period, inventory turnover period also we used to say. Sorry. So here, this is like average debtors average debtors divided by credit sales, entire number of sales is given as credit sales into 360 days. Into 360 days. So average debtors, average receivables is given 360. 360 divided by 2400 multiplied by 360. Okay. 360 divided by 2400 multiplied by 360, 54 days. Okay. Now, inventory turnover period was 70 days, debtors collection period, or I'll go with the modern terms. Days inventory outstanding is 70. For 70 days, you are holding your working capital in the form of inventory. Time taken for inventory to be converted to debtors or sales. Now, the debtors you are keeping days sales outstanding, a credit sale form you are keeping on average 54 days. Once you make the sale, it takes 54 days on average for you to recover the money. Okay. Then days payable outstanding, DPO, days payables outstanding. Days payables outstanding. Days payables outstanding, DPO. DPO. Sorry, I should have written DPO first. DPO, days payables outstanding, or in other words, creditors, good old days the term. If any of you are familiar with the older terms, I'm referring to that also. Creditors settlement period. So through this ratio analysis, we can do a preliminary study. Right? So average trade payables is there. Average trade payables. Average trade payables divided by ideally it has to be credit purchases, but we don't have credit purchases, so we'll have to go ahead with cost of goods sold. Value of raw material if you have in cost of goods sold, yeah, we don't know, right? It has to be value of raw materials, right? Ideally, so we'll go with cost of goods sold. Cost of goods sold. This is like, ideally it has to be credit purchases, but we don't have credit purchases given separately, so can't help. Into 360. So how much is this? Average trade payables is 210. Cost of goods sold is 1440 into 360. 210 divided by 1440 into 360. 52.5 days. Now here, which is one reason why they would have thought, let's get it down to 90 days, because now it takes for us to convert the inventory, the finished goods into a sale debtor 70 days, another 54 days for us to recover the money from the debtors, and along with that, within 52.5 days, we have to pay money for creditors. So we are at a working capital requirement always. Our creditors are small, inventory plus debtors is large. Current assets are much larger than the current liability. So we are at a problem. We are at a working capital problem. Yes, that's true. Now to mitigate that, they suggested, okay, go on for extensive credit period, right? Negotiate with the suppliers. Improve the receivable collection by strengthening credit monitoring and 2% early settlement discount within 30 days. Okay, bring it down to 30 days. So 60% of the customers will take it up. Reduce inventory holding period by 20 days. So 70 days to be brought down to 50 days. Those are the three actions that have been proposed. And also we can look at the operating cycle and the cash conversion cycle. Okay. Operating cycle means, those are also some preliminary assessments. Operating cycle, if you can refer my working capital video number 1, operating cycle, you get this DIO rather, debtors, inventory, sorry, it's not D, it has to be DIO, sorry. Right, there's an error here. Days inventory outstanding, DIO plus DSO. DIO plus DSO. DIO plus DSO. So that is equal to 70 plus 54, 124 days. 124 days. Then cash conversion cycle, CCC, cash conversion cycle. This is OC. Cash conversion cycle, CCC, cash conversion cycle. Operating cycle, either DIO plus DSO minus DPO, payable account, or else in other words, DIO minus DSO means operating cycle minus DPO, that is 124 days minus 52.5 days. So how much is that? 124 minus 52.5 days, 71.5. 71.5 days. So these are some of the preliminary assessments that you can do. So this is good enough, like they are giving 7 marks. If you properly explain all these things, you should be getting all the, sorry, not 6 marks. I think it's 7 marks, right? Yes, 7 marks. Okay. Analyze, part B, analyze the financial viability of offering a 2% settlement discount as proposed in measure 2 above as requested by senior management. I feel this 25-mark question is a relatively easier one compared to some of the 10-mark questions that we did. But at the exam, my dear students, my recommendation is, it's up to you, right? You might feel sometimes the 25 marks questions are easier. You might start attempting them. There are 2 25-mark questions that you need to do. 50 marks they carry, yes, if you do them properly. 50 marks itself will get you a pass, right? But there's a risk because the paper is only 3 hours, okay? If you spend about like 1.5 hours to 1 hour and 45 minutes or something like that for those 2 questions, you are in a panic situation. Another 5 more questions you have to attempt within 1 hour or 1 hour and 15 minutes or somewhere there, which may not be practical. So my recommendation is, do at least 2 or 3 questions out of 10-mark questions, or if possible all 5. Whatever possible you answer, because those are mandatory. But keep about 1.5 hours or so for the 25-mark questions as well, right? Or if you feel like that approach is not going to work, do at least 2 or 3 questions out of 10-mark questions within 1 hour or 1 hour and 15 minutes. So about 30 marks you have scored. Out of 30, let's say you have scored 20, 25 at least. Then you are in a safe zone to go for the bigger questions. So have your own methodology, but that's my recommendation, because there's a risk when we start doing the 25 mark questions. Sometimes if you do it quickly, now this question is something that we can do quickly. Not very difficult, but don't expect the same level at the exam. It can be slightly difficult. So please go through other working capital questions that I have done from the past papers and other questions. Look at those things as well, and then we never know, if we get something like this, great, right? But if we don't get, if we get a tougher question, it'll be a problem. So it's up to you. You take the 15 minutes, read these things and see which one is easier for you. Start doing from that. Okay? And pick up which 2 questions you are going to do out of the 3. If possible, within the 15 minutes, you try to decide that. If not, it's up to you, right? At that point, even you can decide, because otherwise you don't have time to read all the questions. It will take more time. So use the 15 minutes of reading time effectively, especially for you to look at the big 3 questions and out of them select 2. Others anyway you have to do, no? Others also you look at the required part. Don't read the entire sum. Required part, okay, from what area? Environmental costing, working capital, transfer pricing, standard costing, budgeting. Likewise, you identify which areas you are most comfortable with, start from there. Okay? Analyze the financial viability of offering a 2% settlement discount as proposed in measure 2 above, as requested by senior management. Okay, financial viability of offering a 2% settlement discount, right? 2% settlement discount, right? So what can be done? What they say is point number 2 here: improve receivables collection by strengthening credit monitoring. Additionally, offer a 2% settlement discount to all customers who pay within 30 days. It is estimated that 60% of the customers will take up this option. Okay, so out of the average debtors, 60% is going to take up this. Okay, right. Okay, right. Cost of capital is given 12% per annum. Okay, cost of capital is given 12% per annum. Current days of sales outstanding for part B. Current days of sales outstanding is 54 days, right? For 60% of customers who accept early settlement offer, new DSO only for 60%, not for the balance 40%, still it's going to be 54 days, right? New DSO will be 30 days. They'll be paying within 30 days. So you are giving a discount of 2%, right? So reduction in debtors collection period or days of sales outstanding will be 54 minus 30 by, there's a 24-day reduction for 60% of the customers only. This is only for the 60% of the customers. Please remember that, not for all. Now, along with that, let's check. At the moment, no discount is given, no. At the moment, we have, my dear students, average trade receivables 360. Average debtors is 360. On that, if you don't give a discount, on average, at any given point, your balance sheet carries a debtor balance of 360 million. Right? 360 million. Now, on that, if you want to if you are financing by a working capital loan, you have a lot of inventory, you have a lot of debtors, other side creditors are we are getting a lower credit period, we are settling them. The balance part you are financing by a working capital loan or something, the cost of capital is given 12%. So the debtors will have to be financed at a cost of 12%, right? So we'll say as a note. Now, these notes are not mentioned in your suggested answers for you to understand. Company's working capital is tied up in the form of inventory and debtors. Inventory and debtors. Okay. Inventory and debtors. Right? Inventory and debtors. Right? On the other hand, creditors are to be settled soon. That is in 52.5 days. Okay. Creditors are to be settled soon. Right? Creditors are to be settled soon. Okay. If balance, WC stands for working capital requirement. To save the time, I'm writing working capital requirement is financed by a working capital loan. If the balance working capital requirement is financed by a working capital loan, I'll move on to the next page. The finance cost is at, we take the cost of capital, we don't know whether it's debt capital or equity capital or whatever, it's given cost of capital 12% per annum. So in that case, at present, average debtors or receivables, is given 360 million rupees. Cost of financing debtors is 360 million into 12%. 360 million into 12%. 360 million into 12%. 43 rupees 43.2 million. 43.2 million. Right? If early settlement is offered, Okay. 60% of the people will take up. 60% of credit customers will exercise it. Okay, that is 360 million into 60%. 360 million into 60%. 260 million rupees. 216 million rupees. Okay. Sorry, you can't go with 360 million because it's on the total credit customers, no? Total credit customers, it should be on the total credit sales. Total credit sales, which is, yeah, 2.4 million. 2.4 million. Sorry about it. 2.4 million, my dear students, here. Annual sale, 2,400 million into 16%. How much is that? 2,400 into 2,400 into 60%. 1,000, okay. 1,440 million. They will enjoy this. They will enjoy this discount. So, yeah. So, early settlement discount. Early settlement discount. It's a discount allowed. We recognize 1,440 in our books. Enter 2,400 we are recognizing as debtors, out of which 40% they are not going to enjoy the early settlement discount. So 60%, 1,440 million they are enjoying. So we allow discounts. Early settlement discount offered will be a P&L cost. Early settlement discount allowed will be a cost to us, which is 1,440 million into 2%. 2% of that. 1,440 million, or just say 2%. 2% of that. Into 2%. 0.02. 28.8 million. Rupees 28.8 million. Okay. And for the creditors, okay, cost of financing debtors, if we get, cost of financing debtors, if we get, 60% is 1,440. 1,440 people, they are going to enjoy only 30 days of credit, 360. At the rate of 12%. At the rate of 12%. I won't put this thing here. At the rate of 12%. So 1,400, you understand? 1,440, the 60% of the people. This is the 60% of the people. 60% of the people, right? Early we got that, no? They are enjoying only 30 days of credit period. So we have to finance them only for 30 days. At any given point, it will be just the 30 days. Yeah, correct. Because earlier we didn't go for that kind of a calculation here. We had this figure 360 million given. So if you want the percentage, we got the 54 days, 2,400 to 54 days, how much? That way you would have calculated this. That will give you still the 360. So that's why we didn't do that. But here we have to do that. 1,440 into 30 divided by 360 into 12 divided by 100. 14.4 million rupees, 14.4 million, and rest of the 40% in the sense 2,400 million into 40%, right? 40%. That is how much you get. 2,400 into 40% will give you 960 million. 960 million. They are anyway going for usual 54 days into 12% is the finance cost of capital. So 960 into 54 divided by 360 into 12 divided by 100. 12% means 12 divided by 100. You know that, right? Rupees 17.28 million. Now, when you add up these two itself, it comes to 43.2 million, which was equal to our previous cost of financing the debt was 43.2 million. Additional 17.28 million we are getting here, right? When you add up these three, 17.28 plus 14.4 plus 28.8, 60.48. 60.48 million is the new cost of financing debt. New cost of financing debt. New cost of financing debt. Okay, 60.48 million. So there's an additional cost of 17.28 million. Our question was evaluate whether analyze the financial viability of offering a 2% settlement discount. Financial viability, right? So therefore you can say net increase in cost of financing debt is 60.48 minus 43.2 17.28 million rupees, 17.28 million. Therefore, early settlement discount option is not financially viable. Let's hope and pray the questions are going to be easier like this. But now when you are at this level, 14 out of 25 is earned, you are in a happy situation, right? Okay. Calculate the benefit of from the negotiation of extension of the supply credit as proposed in 3 above. Benefit. Is there a benefit? Yeah, because right now it's 52.2 days creditors. 52.2 days DPO. DPO is 52.2 days. Right? You're talking about moving it down to up to 90 days. So the benefit we can only 2 marks given. So I mean that we can easily do. Right. Okay. Part C. Current days of payable outstanding DPO is 52.5 days. If we negotiate the new DPO is 90 days. 90 days, the current average payables outstanding is given. Average payable outstanding is given 210. 210. Current average payables outstanding equals 210 million. It is given 210 million. New average payables outstanding would be so it will be like on cost of goods sold, no, cost of goods sold 1440. This is 1004. Now all figures are very much alike. The examiner, in this case whoever who set the paper, jumbled the answer. 60% of 2400 is also this, cost of goods sold is also this. I don't know, it should not be the case, but anyway, right, this is average, not the average, this is cost of goods sold, right? Cost of goods sold, not the 60% of that debtor balance, right? 1440. Now we are enjoying 90 days of credit. 90 days of credit. 90 days of credit. 90 days of credit. 1440 into 90 divided by 360. It's 360 million. 360 million. So we have an increase, the difference of these two. Actually, I should have written this one minus the other one. Net increase in average creditors, average payables, right? Net increase in, I'll use the modern word, average payables, 150 million. So your cushion, your creditor balance go up by 150 million. You don't have to find that working capital. The working capital requirement reduces. When creditors go up, working capital loan requirement reduces, and you are saving a cost of finance. Only 2 marks are given, I don't know, right? But that's fine because they have given more marks for even easier stuff, no? When average payables increase, when average payables increase, working capital requirement comes down, cost of financing working capital comes down. So this is fundamentals. Traditional way, delay your payments as much as possible. Collect your money as early as possible. The cheapest way of financing is creditors, trade creditors, 0% interest paid. So that is the traditional thinking in working capital management. That's what we also learned earlier. Now, strategic working capital requirement, it thinks in a different way, supply relationships and all, but conventionally, that's what we thought. So on that aspect we get saving in cost of financing working capital would be on this 150 million. Working capital requirement goes down by 150 million. Now here average creditor value goes, payables go up by 150 million. Working capital requirement comes down by 150 million. So cost of working capital financing coming down 150 million into 12% because we are financing at the rate of 12% the cost of capital. 150 million at 12%. Rupees 18 million. Rupees 18 million. Okay, rupees 18 million. Benefit in reduction in working capital financing. Okay. Part D speaks about discuss the potential adverse impacts of the proposed working capital measures on companies, customers, suppliers, and operation performance. Sorry. If we go on with this approach, if we give the discounts and ask our customers to pay early, and if we go with like negotiation with the suppliers for extending the credit period up to 90 days, this is done for the whole, like all the creditors we are doing that. And also operational performance and potential adverse impacts. Discuss. So 6 marks are given for discussion also. So at least 3 points we need to discuss for customers, suppliers, and operational performances, right? Okay. And also we are talking about reducing inventory hold period also, no? Proposed working capital, the point that we didn't go on to elaboration was reducing the inventory holding period by 20 days. So when you reduce inventory holding days, maybe you will run out of stocks. The customers might come and demand for your product, but it's not available. Stock out situations can occur, right? Now, early settlement discount is a good thing. I mean, financing wise, now we saw it's bad. But overall, if the customers can do that, they will give you money quickly. So that's a good thing. Risk of bad debts is somewhat reduced. But the customers who are unable to meet that requirement, they will feel okay, they are neglected, they can't enjoy this 2% benefit, and they are not valued, something like that. And with that, it can affect the long-term relationship with the customers. So they might shift to another supplier who might offer a 1% discount. Maybe for 60 days or 90 days, they might go for another difference. So loyalty and the customer relationship can affect for those who can't afford for early settlement discount. And yeah, so those are the 2 main points. And if you take the suppliers, extending the 90 days, it's bad for suppliers' cash flow, and that can affect your long-term relationship with the supplier as well. Suppliers limited liquidity. Supplier might increase prices if you ask for more credit period. They might say, okay, now we are giving at 200 rupees because you are paying us at 52 days. If you want 90 days, we'll be selling at 300 rupees. So they might increase price. So strategic partnership and the relationship can be adversely affected. Operational performance also, it's like, okay, operating cycle and cash conversion cycle will be affected. Aggressive inventory reductions may increase the risk of production delays. Now, you see what will happen to the new, this part is not given, right? What will happen to the new these things now? Okay, this is 54 days now. And even here 70 days. What we are proposing with the new working capital, this thing, it will come down by 20 means it will become 50 days. Okay, don't write it, but I'm just showing you, right? And also, this 54 days partially will go on for 30, partially will be 54. 54, 40% of the people, 60% of the people, 30. 52.5 days go for 90 days. Right, so if you take an average of this thing, 30 into 60% plus 54 into 40%. 39.6 days like, okay. 39, but don't write, just, I mean, if you want, you can note down somewhere, but just a revised calculation. So what will happen to operating cycle? Okay, 50 plus 39.6, 89.6, it's improved. Cash conversion cycle, 89.6 minus 9, it's minus 0.4. So you don't need a working capital at all, like, right? Cash is available. You don't need a working capital at all, right? So it's something like that. Okay. So that's one aspect. Yeah. So we'll write down part D. Potential adverse impacts. Potential adverse impacts on customers okay, reducing inventory period. You can write down in sentence forms, right? But just give it in the short form, mind map form. Can result in, I'll just write it. May result in stock out situations may result in stock out situations that results in delayed delivery, poor service, and reduced customer satisfaction or trust. Customer satisfaction. That is one point. Then on the customer, the other thing is offering early settlement discounts. Offering early settlements discounts for those customers who cannot enjoy the benefit, okay, you cannot enjoy the benefit, The long-term relationship and loyalty may be tarnished or affected. They might move on to another supplier who still give a discount at a higher settlement period, or they may not be happy. You are favoring the customers who are like paying early. That's one aspect, right? So strategic customer relationship maintenance can be spoiled in this approach. Suppliers. You can put point form or 1, 2 or whatever. New credit term of 90 days. Negotiated credit term of new credit term of 90 days may or will. Like our question is about the potential adverse impact. May, or unless they have factoring facility or whatever, adversely affect cash flows of the supplier cash flows okay, supplier cash flows if they are smaller suppliers with limited liquidity, that will affect their long-term relationship also, right? Especially, unless they have factoring or invoice discounting or whatever the methods. Small suppliers with lower liquidity long-term relationship will be affected. Long-term relationship will be affected. A third point, suppliers may tend to increase prices for higher credit period. That's an adverse impact on us. Suppliers may increase RM prices, or they might also say, okay, you settle early, we give you a discount. RM prices for higher credit period. Or they also can do the same thing that we are doing, or offer early settlement discounts while base price is higher. Normal price for 90 days is higher, and they might say, okay, you settle early, we give you a discount. We give you at the older price. Okay? So that again affects our relationship. Weak strategic partnerships and disrupt supply chain reliability. They're asking about operational performance also. In terms of operational performance, how it's going to get affected? Sorry. Operational performance. Operational performance. Any inventory reduction, not just the finished good inventory, raw material inventory also can be reduced. So risk of production delay. Inventory reduction. Inventory reduction also can happen. Raw material inventory may be reduced. I'm writing in short form to save time. Production delays are caused. Right? Production delays are happening. Right? Then finish goods inventory coming down. It's not like just in time approach, no? Right? Difficulty in managing fluctuations in customer demand. If the customer demand comes down, it's okay. If all of a sudden, like a part-time customer demand, what do you know? All of a sudden it goes up, you should have a buffer stock or an inventory. Fluctuation in customer demand. Fluctuation of customer demand. Fluctuation of customer demand. Right? And these things can affect. These things can affect again adversely. Customer relationship already we spoke, but loss of goodwill and all can happen. Customer relationship, loss of goodwill means here the good name, and loss of future sales, loss of customers, loss of sales, loss of future sales, loss of goodwill, all these things can happen. Stock out situation, you know, the adverse impacts of stock out costs you can talk about here. Part E, present 3 supply management strategies that can be used when negotiating extended credit supply terms. Negotiating extended credit supply terms while strengthening supply relationships. Okay, extending supply management strategies that can be used in negotiating extended supply credit terms. Supply management strategies. Supplier management strategies. The question is, present 3 supply management strategies that can be used when negotiating extended supply credit terms. Negotiating extended, because it's a good thing, not a bad thing. Credit terms while strengthening supply relationships. How can you do that? While strengthening supply relationships, you negotiate the extended credit terms. What are the strategies that you can adopt? So this is modern management accountant's role in working capital management we are talking about, right? The negotiation process has to be collaborative and transparent. Now, you know, there are 5 approaches that we can take. win, lose, win, lose. Okay. Right? If it is a win-win solution, we say it's a collaboration, collaborative approach. Okay. If it is like this is us, this is creditor, other party. We are losing, but other party is winning, accommodative. We are losing, but other party is, winning, accommodative. We are winning, but other party is losing, we say forcing. We are losing, other parties are also losing. Actually, there's no negotiation there, right? There's a word for that. I can't recall exactly. It's kind of like useless for anybody, right? But some, not a 100% win-win solution, but some portion they also sacrifice, some portion we also sacrifice. That is called compromising. This is like avoiding kind of like no negotiation. No win for you, no win for them. Avoid. This is not recommended, but compromising means sacrifice. Both parties sacrifice to some extent. So it's a collaborative win-win situation if we go for. Adopt a collaborative, transparent negotiation approach. So the first thing is adopting a collaborative. You may take down this negotiation approaches. Compromising is here. Compromising. This is negotiation approaches. Negotiation approaches. For anything, even for peace talks between countries, or maybe like trade agreements between countries, trade agreements between two companies, anything. So this is about supply and us. Adopting a collaborative, transparent approach is number one. Collaborative, transparent approach is number one. Offer mutual benefits to supply. Okay, we are winning. This is a win-win. No, collaborative is win-win. Collaborative is win-win. Okay, we are winning. What is our victory? We are getting an extended supply term period, and we don't want to finance ourselves with working capital. That's a great achievement. But what do they get? Offer mutual benefits to the supplier. Offer mutual benefits to the supplier. For win-win, what do they get? Examples are there: long-term supply contracts, committed order volumes, improved demand forecasts, selective early payments. We also can do that, right? If we are better off. Examples you can write down. Examples. Long-term contracts. We are going to sign a 5-year contract with you. We are going to buy only from you. Right? Committed. I'll erase this part. It's win-win. order volumes, committed order volumes, improved demand forecast, improved demand forecast, improved demand forecast, improved demand forecast. Selective early settlements like our customers do. We also can do early settlements time to time whenever we have better cash flows. So those are kind of like, positive impacts for them. They also feel, okay, we are getting promised orders, order volumes are like, going up, committed, and there'll be increasing demand also in the future. So they'll be buying more material from us. And time to time, whenever possible, they'll pay us early as well. They don't want to wait till 90 days. So that's a good approach. Okay. Prioritize strategic suppliers through segmentation. Okay. Prioritizing suppliers. Strategic suppliers. Prioritize strategic supply. The key suppliers you should give some favor. Not all the suppliers you may not be able to satisfy. Your main suppliers, if you are now this is a food company, your main raw material is tea leaves, like who are the main suppliers, they must be kept on satisfaction. The company should identify and focus negotiations on key strategic suppliers that are critical for operations, right? Negotiate strategically with key trade suppliers, key strategic suppliers. Okay, key strategic suppliers that are critical. They are critical for your operations. Tailoring payment terms to supply inbounds and risk profile demonstrate partnership intent and help strong. Okay, that means like basically you segment, put them into different segments. The key ones you always prioritize their payments, go with favorable conditions with them and all. That's the whole idea. So if you write down something similar, you'll get full marks for this. So this is a relatively an easier question, my students, compared to working capital, some of the questions that we have done. But I hope you get something similar, something simple like this, so that it won't be much of a problem for you all to score 25 marks, or at least close to 25 marks out of the question. This is on capital budgeting and project evaluation. Sorry, question number 7. We did question number 6. 5 questions of 10 marks, and this is what we did was question number 6. Okay. Question number 7. Aquatech Solutions Private Limited is a leading manufacturer of water purification and filtration systems in Sri Lanka. So you see, most of these questions you are getting from manufacturing, water purification, something to do with the sustainability. So the examiner is thinking in that line now. Right? Is a leading manufacturer of water purification and filtration systems in Sri Lanka, supplying both residential and commercial customers across region. Okay, water purified, water පිරිසිදු කරලා and filtered. Right? So it's a leading manufacturer in that, and they are supplying both residential and commercial customers across the region. The company is recognized for its innovative products, high quality standards, and strong market reputation. right? So they are like both residential and commercial customers. They are doing water purification and filtration systems. Companies recognized for its innovative products, high quality standards, and strong market reputation. Senior management is considering a strategic expansion project to establish a new production line for smart water dispensers to meet rising domestic and regional demand. So, senior management considering a strategic expansion project to establish a new production line for smart water dispensers, a new production line for smart water dispensers to meet rising domestic and regional demand. The company has an existing capital budgeting process to evaluate investment proposals. However, senior management has identified that the current process requires improvements to better alignment with strategic objectives. Financial viability and risk considerations. Accordingly, senior management has requested a detailed evaluation of the proposed project to decide whether it should be undertaken. Okay, current process requires improvements to ensure better alignment with strategic objectives, financial viability, and risk considerations. Right? Current process requires improvement. Better alignment with strategic objectives, financial viability, and risk considerations. A detailed evaluation is required on the proposed project. The proposed expansion project requires the purchase of new machinery and installation of a production line with the following financial implications. Initial investment payable immediately rupees 500 million. Expected useful life is 5 years. Estimated residual value at the end of year 5 is 50 million. Annual incremental cash inflows before depreciation is 300 million per year. Annual incremental operating cost cash based is 100 million per year. Immediate incremental working capital requirement is 50 million. Depreciation straight line basis over the project life. Cost of capital 20% per annum. Ignore taxation for appraisal purpose. So tax adjustment is ignored. Most of these questions we got tax adjustment ignored. Lucky if you are getting like that, but tax adjustment also can come. Then you should know tax. There's an interest cost saving based. The tax saving based on the interest cost. But other than that, entire thing will be taxed at an even rate. But here you can ignore the tax. You're working as the corporate management accountant of the company, and the head of finance has been asked to prepare a note for senior management. You have been requested to provide support to the head of finance in the following areas. So explain briefly the key stages of proper capital budgeting process and its importance for an. So this is theory. They're asking explain briefly the three stages. Explain briefly the key stages of a proper capital budgeting process and its importance for an organization. Okay. Examine the proposed project using appropriate investment appraisal criteria. 3 that considers the time value of money and 1 that does not. Okay, we'll come to that. 14 marks. And discuss whether the proposed expansion project is financially acceptable. Okay, we'll come to that. Yeah. Key stages of a proper capital budgeting process. Key stages of a proper capital budgeting process. So 6 marks are given. We should write about 5 to 6 points. We can explain what is capital budgeting in a nutshell. What is capital budgeting actually? Capital budgeting process is a systematic approach used by an organization to identify, these words are key, to identify evaluate, approve, implement and review. Identify, evaluate, approve, implement and review long-term project evaluation, long-term investment projects. Long-term, you don't have to by heart this definition kind of a thing, but this idea try to write down. Long-term investment projects. Okay. So what are the key stages? Number 1, project idea. You have to identify what the project is and the ideas have to be generated. Project identification. And idea generation. Okay, that you need to explain a little bit now. In the interest of time, I will just read out what is suggested in the answer. I'll explain that. Potential investment opportunities are identified from various sources. So it's like There may be various project opportunities. You will need to identify what is the best one. The project potential investment opportunities. So first of all, you need to identify what are the investment opportunities from various sources such as operational needs, market expansion, technological changes, regulatory requirements, sustainability initiatives. We learned about sustainability as well. At this stage, ideas are broadly aligned with the company's strategic decision. Company strategic direction එකත් එක්ක align වෙන ideas වෙන්න ඕනේ. The idea generation and the project identification out of various things, maybe the market analysis, market expansion, operational requirements, technology changes, needs, regulatory laws and regulations requirement, and sustainability initiatives is what you need to look at, right? Then you move on to the next step. So I'm not going to write them. I mean, just listen to the video and maybe you can refer the suggested solutions also and come up with your own answer, right? Initial screening of the project. Initial screening. This is the theory of the long-term project evaluation. Now, projects are screened using qualitative and basic financial criteria to eliminate proposals that do not meet requirements such as strategic fit, technical feasibility, legal compliance, and affordability or affordability constraints. So now we identify different project opportunities now. Out of them, we are doing an initial screening and see using qualitative aspects as well as basic finance, not going into NPV or whatever in detail, but basic financial criteria and qualitative aspects like are there any projects that don't meet our minimum requirements? You can just forget about them. If it is not going in line with our strategic decision, the strategic fit is not there, you can forget about it. It's something diverting from that. And maybe about the technical fees. Technically, are we competent enough to evaluate and do this project? If we are not competent enough, or if we don't have resources, or if we don't have a way of finding out resources at a reasonable cost, forget about it. Legal compliance, if there's an issue, forget about it. Affordability constraint, we can't. I mean, the initial financial requirement itself is something that we can't meet. Forget about that, because however good the project is, unless partial investments are possible, you don't have to look at it. Then you go for financial appraisal. This is what we are mostly studying in the project evaluation also. Financial appraisal. Once you are selected, now you are financially evaluating. Earlier it was a basic financial screening. Financial appraisal. Earlier one you can mention, it is using qualitative and basic financial criteria. Basic financial criteria. Okay. Financial appraisal, whether the projects are viable or not, you can look at different approaches. Non-discounted cash flow methods are there. Non-discounted cash flow methods are there, like accounting rate of return and payback period. Accounting rate of return and payback period. Discounted cash flow methods are there. Now, if you write down for the second part also, you have the answers, the methodologies. NPV, IRR, discounted payback period. Discounted payback period. Modified IRR, MIRR and all. Advanced level we study. Right? So those are there. And assessing the incorporating the time value of money estimating relevant cash flows, assessment of financial risk. Approval and final decision is the fourth point, next point. Once you decide based on this method which one is the best or which options are we going to take part in, approval and final decision. Approval and final decision. Now that is where senior management reviews appraisal results and prioritizes project based on value creation, risk, capital constraints, and strategic importance. Decisions are also made regarding the method of financing, such as internal funds or external borrowing. Okay. Implementation and okay, so they are like prioritize the project based on value creation, risk, capital constraints, and strategic impact. Priority is given based on value creation to the business value creation, risk, capital constraints, strategic importance. Decisions are also made regarding the method of financing. How do you finance the required amount? Internal funds or external borrowing, or you go for equity or debt or whatever. Implementation and post-implementation review will be the final. Implementation, or you can bring it as 2 points also. Fifth one is implementation, sixth one is post-implementation review. Post-implementation review. Post-implementation review. Once approved, the project is implemented and monitored against the budgets and the timelines. After completion, a post-implementation review compares actual outcomes with forecasts to identify variances and improve future capital budget decisions. Once the approval is given, you go on for implementation. Project is implemented, then your post-implementation review, you are monitoring it against the budgeted figures, right? And also compare the actual outcomes with the budget, the variances and all, and identify variances, improve future capital budget. So if there are big variances, you learn out of that and improve your future capital budgeting decisions. A structured capital budgeting framework is important because it ensures capital is allocated efficiently, projects support long-term strategy, risks are properly assessed, and shareholder value is maximization of shareholders' wealth is the prime objective in financial management. Weaknesses in this process may lead to poor investment decisions and inefficient use of scarce financial resources. So our money should not be wasted. We have to be very careful where we are going to invest. So that's the whole idea. I mean, if you write down this, you'll get 5 out of 6 marks or even 6 out of 6 marks without a problem. Examine the proposed project using appropriate investment appraisal criteria that considers time value of money and one that does not. So we learned about different methods: NPV, IRR, discounted payback may be 3 discounted cash flow methods, maybe ARR or payback may be one of those methods we can use for like what do you call non-discounted cash flow method. Right, so anyway, first of all, we'll estimate the cash flows given. The initial investment payable immediately is 500 million. Okay, 500 million. Right. Part B. Initial investment is rupees 500 millions. Expected useful life is 5 years. Estimated residual value at the end of the year 5 is 50 million. Annual incremental cash flows is 300 million. 300 million. Okay. Annual incremental operating cost is 100 million. Okay. I'll put it like this. Residual value is there 50 million. Residual value at the end of the period is 50 million. 50 million. And annual incremental cash inflows. Cash annual incremental cash inflows. This I'm going in rupees millions. 300 million per annum. Incremental operating costs minus annual incremental operating costs. Annual incremental operating cost is 100 million per annum. Immediate incremental working capital requirement is 50 million and additional working capital, that's separate. Depreciation or straight line basis. Now with that we can go for the accounting profit if you want. Depreciation, how do you get? Annual depreciation will be over a period of 5 years, no? Cost minus residual value over the useful life. So cost minus residual value over the useful life. $500 minus 50, 450 divided by 5 years. 450 divided by 5 years. So you get another 90, right? 450 divided by 5 is 90. Cost of capital is there. So with that, I think you get annual accounting profit we get. Annual accounting profit you get from this inflow incremental revenue minus incremental cost minus depreciation, you get 110 million. So you can find out the accounting rate of return. Accounting rate of return. Okay. Accounting rate of return. One undiscounted cash flow, even the payback method you can go. Average annual accounting profit divided by average investment into 100. Now average annual accounting profit you got here 110 million. 110 million. How do you get average investment is a bit tricky because the residual value is there. Initial investment is 500. If you don't have a residual, it's 500 divided by 2. But you have a residual value now. So what you have to do is opening investment plus closing investment divided by 2. This entire thing. Okay. This is opening investment plus closing investment divided by 2. So you get 110, okay, multiplied by 100 is there. 110 over 550 divided by 2 into 100. Or in other words, 110 divided by 550 divided by 2 is 275. Check with your calculators. The accounting rate of return we get 110 divided by 275 into 100, 40%. 40% is the ARR. This is a bit difficult one, but I did that because you will, easier one would have been the payback method or something, but I just wanted you to get an understanding on this. Okay. Right. Then we'll go for NPV, IRR and the discount rate because three that considers the time value of money they're asking. Three methods that consider the time value of money they're asking. Okay. Right. So the estimated cash flows are here. Year 0 estimated cash flows are year 0, no tax adjustment coming in. 500 and there's a working capital requirement also, 50 million initially, but that you can recover finally, right? We'll put it like this. Estimation of cash flows. Cash flows. Okay. Year 0. We'll put it like this. Year 0, 1 to 5 we can get, and year 5 separately we can get. Or you can do 1, 2, 3, 4, 5 even, no problem. Initial investment, all figures are in rupees millions. Rupees millions. 500 million investment. Working capital investment 50 million, right? Net operating cash flow, you get annual cash flow 300 minus annual operating cost, right? Net operating cash flow is this annual cash inflow increase is given 300, annual cash outflow increase is given 100, so you get 200 from year 1 to year 5. Depreciation doesn't come because it's not a cash flow. And then the working capital is recovered. Working capital is recovered at the end of the 50, right? This is recovery of working capital at the end of the 5 years. Recovery of working capital, and even initial investment you are recovering 50 because it's a residual value. There's a residual value. Got it? So year 1 to year 5, nothing happens. Only the 200, but here you get it like that. So overall, year 0, we need to find 550 initial investment plus the working capital requirement. So here this is good. They are slightly complicating with the working capital requirement. Year 1 to year 5, every year we are getting a net cash inflow of 200. Year 5 only additional 100 comes, the residual value and the recovery of the working capital. Okay. Right. Now it's a matter of like they have given the cost of capital is 20%. Okay. Right. We'll do it like this. Year 0, 1 to 5 and 5. The cash flow is 550 negative in rupees millions. Rupees millions. Okay. 550 negative, 200 year 1 to 5 and 100. 200 year 1 to 5 and then 100. No tax adjustment. Okay. Discounting factor at 20% you can find out. Year 0, the discounting factor is always 1. Okay. All of you know that discounting factor you find 1 upon 1 plus r to the power n. But in a special situation like this where you have an annuity, okay, present value interest factor annuity, or in other words, annuity factor, unless the examiner gives you that. I don't think he's giving, it's an easy question, he won't give you. He will expect you to find it out. 1 minus discounting factor divided by r. 1 minus 1 upon 1 plus r to the power n divided by r. So r is 20% here. R is 20% here. 20% means 20 divided by 100. Put it as 0.2. Okay. Number of years is year 1 to 5. No, year 1 to 5, 5 years are there. Excluding year 0, year 1, 2, 3, 4, 5. 5 years you are talking about, 5 years are there. Now substitute it here. This is how you are going to do it in your calculator. 1 minus 1 divided by 1 plus 0.2, or in other words 1.2. 1 plus 0.2. Right? Put a bracket if you want. Even without a bracket, that's okay. Still, BODMAS rule will be applied. Right? 1.2, 1.2, okay, 1.2 to the power 5, you get the answer. Get this answer. So I'll do that. 1 minus 1 divided by 1.2 to the power okay, in this particular calculator, now it's difficult for me to find the power buttons and old calculator. Okay. One minus 1 divided by 1.2 to the power 5. Answer you get 0.5981. 0.5981 something. That answer, now this is 1 minus 1 divided by 1 plus 0.2, 1.2 to the power 5. The upper bracket part you have done. Divided by 0.2. Divided by r. Divided by r. R is 0.2. 20% is 0.2. Divided by 0.2. You get 2.9906. 2.9906 or 91 the examiner has given. So it's okay. 2.9906. Please note down this because I'm going to erase the black color part. 2.9906. Okay. 2.9906 or 991, even if you take up to 3 decimal places, that's okay. So I will erase this part. Right? So for year 5, what are you going to do? Discounting factor. Annuity factor comes when you have the same annual cash flow every year. So discounting factor, 1 divided by 1 plus 0.2, or in other words 1.2 to the power 5. 1 divided by 1.2 to the power 5. 1 divided by, now you will have a button like this, either x to the power y button or the power button, right? Please use that. 1 divided by 1.2 to the power 5. 0.4018. 0.4019. 0.4019. 0.4019. Okay, right. Now you calculate this. We are going to simply get the NPV here. Discounted cash flow. Discounted cash flow. Year 0, it's always 1. Power 0, n number to the power 0 is 1. So nothing to calculate there. It's 515 to 1. You multiply. You know this. 515 to 1. Then 200 into 2.9906. 200 into 2.9906. 598. 598.12. These are in rupees millions. Millions of rupees. 100 into 0.40, 40.19. So the NPV we are getting 598.12 plus 40.19 minus 550. 88.31 million. So we have done two methods. NPV 88.31 million. So using this you can get the discounted payback period also. But for do that you get the what you call year by year thing. Year by year thing you can get. But beforehand we can get the IRR. We'll use another one. Now we have a positive NPV. We have a positive NPV, my dear students. When you get the IRR, what is internal rate of return? IRR, this is a good question. If you get something like this, the entire capital budgeting problem is revised. But the thing is, you might get things like, okay, capital rationing, divisible projects and all, annual cash flow methods, and use different project periods, 2 different projects to be evaluated. That can come. Those are the complications in NPV. But this simply ARR, payback, discounted payback, NPV and IRR. They have tested here, right? The actual payback, no need to find out. But if you want, you can find out the payback also. Right? So then if you're not sure for going for accounting rate of return, since you are getting discount payback, without the discounting factor, you get the payback. That's it. Okay. Yeah. So we'll go for another one. So here, before going on to that, what I want to tell you was R versus NPV. R versus NPV. So it's a curve, but we assume it to be a straight line here. Internal rate of return is the point where a value of R where the NPV value is 0. So this is the positive side and this is the negative side. Okay. And right now we got this 20%. At 20%, you got a positive NPV of 88.31. A positive NPV of 88.31. So let's try to get somewhere here 30%, 25%, somewhere there. So that a higher rate, you might end up with a negative NPV or even a lower positive NPV. That's fine. We can still project it. But if we have a positive and a negative, even if it's a curve, the accuracy will be higher, right? But you never know until you do that. So go for a higher rate. So we'll go for 30%. That's why we are going for 30%. I just want 30% or 25% if you like. Go for 25%. That's fine. Here 0, it's 1 again. This figure we have to find out and this figure we have to find out. Okay. Now, how do you find out this? The PVIFA equals 1 minus discounting factor divided by R. That is 1 minus 1 upon 1 plus R to the power n divided by R. Okay. 1 minus 1 divided by 1 plus. Now R is 30%. No? So that is 0.3. 1 plus 0.3 to the power 5 divided by 0.3. Okay. 30% is 30 divided by 100, 0.3. So in your calculator, you do 1 minus 1 divided by 1 plus 0.3 is 1.3 to the power 5. How much is the answer? 1 minus 1 divided by 1.3 to the power 5. 0.7307 we'll say. Rounded up to 4 decimal places. Now that 0.7307 has to be divided by 0.3. This answer divided by 0.3. You have this answer button in your calculator. Please use it. Then rounding up errors will be minimum. Rounding up errors will be minimum. You round up only at the final point. Answer divided by 0.3. 2.4356. 2.4356. 2.4356. Okay. 2.4356. 2.4356. Also here, discounting factor is 1 upon 1 plus R to the power n for the year 5. So R is equal to 30%. 1 plus 0.3 to the power 5. That is 1 upon 1.3 to the power 5. That you can find out. 1 divided by 1.3 to the power 5. 0.2693. 0.2693. Okay. So the discounted cash flow 550, sorry, This into this, we are going with, be careful here. This multiplied by this. 200 multiplied by this. 100 multiplied by this. Because there is another set of two columns in between, right? 200 multiplied by 2.4356. 200 multiplied by 2.4356. 487. 487. 487.12. 100 into 0.2693, that is 26.93. Okay, let's see. NPV2, NPV at 30%, NPV at 30%, this is NPV at 20%. Okay. 487.12 plus 26.93 minus 550 minus 35.95. So for minus 35.95. Minus 35.95. It's a negative answer, right? Okay. So how do you find the IRR? IRR equals A plus NPV at the rate of A divided by NPV A minus NPV B into B minus A. So this is a formula. This formula, unfortunately, you'll have to remember. Examiner may not give that. Okay? You have to remember that. So what is A? The lower discounting rate. A is the lower discounting rate. Now in this case, we had two discounting rates, my dear students. We had two discounting rates, 20% and 30%. The lower means out of the discounting rates, the lower, not the NPV lower. Discounting rate, the lower is 20%. 30% is the higher value. 20%. So NPV at the rate of A you got, NPV at the rate of A you got 88.31. 88.31 millions, 88.31. B stands for higher discounting rate, and that is 30%. That is 30%. So NPVB stands for 35.95 minus 35.95. So now you substitute here. IRR equals, instead of A you put 20%. NPVA is 88.31. NPVA minus NPVB 88.31 minus 35.95. Minus means plus ultimately, but you get it as minus. Okay. Into B minus A, 30% minus 20%. 30% minus 20%. 30% minus 20%. Okay. Okay, we can get 20% plus 88.31. Here 88.31 minus minus is plus 35.95, 124.26 multiplied by 10%, multiplied by 10%. So 88.31 divided by 124.26 into 10. Forget about the percentage and just take it as 10. So 20% plus, finally we put the percent. 7.106 or 11%, 106%, 107, 107 like, okay. That is, yeah. So we end up with 27.11%. IRR is almost 27%, 27.11% is the internal rate of return. And now that we have the discounted cash flows, and the discounting factors, everything is there, we can go for the payback period also. Right? So I will use the same thing here, but okay, we'll use it in a different way. Because we want 3 discounted cash flow figures, no? Discounted payback period we can find out. Discounted payback period we can find out. Discounted payback period we can find out. So on this aspect, like when we are getting the discounted payback period, we'll have to, like, we can't go with the shorter forms like this, what we do for NPV and IRR, because you need to get the actual payback. I mean, here we took 1 to 5, 200, but here you'll have to take year 1, 200, year 2, 200, year 3, 200, year 4, 200, year 5, the 200 plus the 100. So likewise, so you have to break it down to get the payback period, right? Even for the payback period, the same. The cash flows have to be expanded. Year and the cash flow 550, year 1 200, year 2 200, year 3 200, year 4 200, year 5 it will be 300. Now simply we could have gone for the payback period also, it will be somewhere between 2 years and 3 years, but we have already got the ARR, no? But I'll just show you, like, I mean, if you are going for the payback period, get the cumulative cash flow minus 550 plus 200 minus 350 plus 200 minus 150 plus 200 will be plus 50. So the gap is like, you know, over a period you get 200, but you have to fill only 150. It's 3/4 of the year, 9 months, 2 years and 9 months will be the payback period. But we are going to use the discounting factors. Now discounting factors at 20% you find out. Okay, year 0 it's 1. This is easier. Now simply because you haven't found it earlier, that doesn't mean you can't do it. Okay. Now discounting rate at 20% will go. That's the given cost of capital. That is easier. 1 divided by 1.2. Simply you get 1 divided by 1.2. 1 divided by 1.2. 1 divided by 1.2. 0.833, or if you want 8333 you can go for whatever. That answer divided by 1.2. So the next one will be this previous answer divided by 1.2. Previous answer divided by 1.2. 0.694 divided by 1.2. Okay, divided by 1.2. 0.579 divided by 1.2, 0.482. This is going on like that. Divided by 1.2 will give you the next one. Year by year, you divide by 1.2. How do you get 1.2? Discounting factor is 1 upon 1 plus r to the power n. No? 1 divided by 1 plus 0.2. 20% is 0.2 to the power n. So 1 divided by 1.2. N equals 1 means year 1, n equals 2 means year 2. So 1 divided by 1.2, that answer divided by another 1.2, that answer divided by another 1.2. If you have watched my project evaluation, the capital budgeting videos, you will know all these fundamentals in detail, right? So I'm just revising here. And the final one divided by 1.2. Answer divided by 1.2, 0.402. 0.402. Right. So with that, now you take the discounted cash flow. Discounted cash flow. 550. 200 into 0.833. 166.6. 200 into 0.694. 138.8. Okay. 200 into 0.579. 579. 115.8. 200 into 0.482. Unfortunately, we have to find all these things, or we can go with the cumulative cash flow also. 300 into 0.402, 120.6. And we'll go for the cumulative discounted cash flow. Okay. Here, like this. So first of all, it's only minus 550. Minus 550. Minus 550 plus 166.6. I have taken up to 1 decimal place. Minus 383.4. Right? So that plus 138.8 minus 244.6 minus 244.6. Okay. Plus 115.8 minus 100 and minus 128 point, sorry, minus 128.8 plus 96.4 minus 32.4. Even if you don't expand, I think still, yeah. Plus 120.6, it will be, but you have to expand because otherwise you'll confuse here. The 300, how do you get? Better do it like this, 88.2. So the examiner makes this difficult by giving a lot of operational aspect here. Now here, my dear students, the discounted payback period means, okay, discounted payback period means right? Discounted payback period means at the point at which the discounted cash flow is going to be 0. Point at which the discounted cash flow is going to be 0. Right? Point at which the discounted cash flow is going to be 0. Now here the shortage is 32.4 because at the beginning of the 4th year it's minus 32.4. So 32.4 short, but during the year we are getting a discounted cash flow 120.6. So this is how we are going to get. It's 4 years plus. It's 4 years plus, but less than 5 years, right? 4 years plus some number of months. So how are you going to get the discounted payback? Just like the payback, but it's with the discounted cash flows. So discounted payback period will be 4 years plus. Here the shortage is 32.4, no? So 32.4 was what we needed to reach 0. But actually we are getting 120.6 throughout the year, throughout the 12 months or throughout the 365 days. You get that much. 120.6 into, let's say, 12. If you multiply by 12, it's months. If you multiply by 52, it's weeks. If you multiply by 365, it will be days. So 32.4 divided by 120.6 into 12, roughly 3.22 you get. 4 years and 3.22 months or something like that. 4 years and 3 months. 4 years plus 3 months or 3.22 months, something like that. Or if you multiply by 365, 32.4 divided by 120.6 into rounding up errors can be there. 365, you end up with 98 days. If you multiply by 365 instead of 12, it will be 4 years and 98 days. Slightly more than 3 months. Okay. So that's how you get that. So please work this out. And even if you want the payback period, basically, like you just based on the cash flows you would get. So you can, if you are not sure about the accounting rate of return, you can go for the payback period, right? So here there's a part C also quickly we'll look at. So out of 25, 20 marks are scored with this. Discuss whether the proposed expansion project is financially acceptable, highlighting the limitations of relying on a single capital budgeting appraisal method. Proposed expansion project is financially acceptable, highlighting the limitations rely on a single capital budgeting proposal. So here, NPV at the rate of what you have to say is NPV at the rate of current discounting factor, the current cost of capital of the company is given as 20%. No, ignoring taxation, we are having a positive NPV. That is okay. And even internal rate of return we got is 27%. That means our cost of capital is expected rate of return is 20%. The project is giving an internal return of 27%, more than our expected rate of return of 20%. So it's okay, good to go. Accounting rate of return 40%, which is fair enough, a good rate of return. Only problem is with the discounted payback period. That's like you are getting only at the end of only last year, 4 years and 3 months. That is where the problem is. But if you look at the payback period again, it will be like 2 years and 9 months or something. Not bad. So overall, we can see it's good, but considering lot of factors like this, lot of methods would be better rather than going for back. Because if you just take the discounted payback, you might say, no, it's not worthy. You have to wait more than 4 years. It may be doubtful, right? So what it says is the examiner project is financially acceptable. It generates a positive NPV of 88.4, IRR 27% more than our expected rate of return, exceeds the cost of capital, recovers the investment within project life under discounting payback, also We are recovering it within the project life. So it's a positive NPV generating. Positive NPV means always we are recovering it. Project is expected to enhance shareholder value. However, reliance on a single appraisal method is not advisable. ARR ignores time value of money. Payback ignores profitability beyond the payback point. IRR may be misleading because it's comparing, it's when comparing mutually exclusive projects, it can be misleading, right? NPV is the most reliable method, directly measures, but NPV also has its weaknesses, but there are ways to overcome those weaknesses, right? Directly measures value creation, but it should be supported with qualitative considerations such as ESG concerns, technological risk, operational capability, strategic alignment. So that's what we gave as the fundamental, no? In the fundamental aspect, like I told you not to worry about this definition too much, but capital budgeting is a process by identify, evaluate, approve, implement, and review long term. So on that aspect, yeah. So on that aspect, it's like ESG concerns, technological risk, operational capability, strategic alignment. Those qualitative considerations have to be supported with the quantitative, the financial consideration of NPV. Accordingly, the project should be recommended for approval subject to appropriate risk management and post-implementation review. Okay. Now we are moving on to the last question, which is on divisional performance measurement. So we are moving on to the last question, question number 8. Let me put up the question on the board. Yeah. So it's about Athletica Manufacturing Private Limited, AMPL, is a large Sri Lankan company engaged in manufacture of sports apparel and professional sports equipment for domestic export market. The company operates through two decentralized divisions, apparel division, division A, and equipment division, division B. The thing is here decentralized. So we know when it is decentralized, it can be a profit center or it can be an investment center. If it is not decentralized, if it is centralized, it can be a cost center or a revenue center. Each division operates autonomously with managers responsible for pricing, costing. Autonomously, they are managing. So investment centers and profit centers have that. Managers responsible for pricing, costing, costs, operations, and investment decisions. So if it is a profit center, it's pricing, cost, and operations, yes. But if it is investment decisions also, manager can autonomously operate the division, then it's an investment center while being accountable for their divisional financial performance. So the managers are accountable for their divisional financial performance. AMPL currently evaluates divisional performance using return on investment, ROI calculated uncontrollable ROI calculated based on controllable operating profit and average divisional net assets. A target ROI of 30% has been set, okay, based on the controllable ROI, based on the controllable operating profit and average divisional net assets, the return on investment. A target ROI of 30% has been set and divisional managers receive a performance related bonus if the target is achieved. Division manager performance related, if they achieve 30% ROI, they get a bonus, in simple, right? Senior management is concerned about the potential dysfunctional behavior arising from use of ROI. Dysfunctional behavior can be good for the division, not for the overall company, right? Suboptimal decisions can be made. Dysfunctional is also similar. The sole divisional performance measure, if you are going by ROI, this dysfunctional behavior can happen. That's what senior management is thinking about. So, consequently, management is considering supplementing ROI with residual income. They are looking at replacing ROI with residual income, RI, and economic value added, EVA, RI and EVA. In addition, the company is reviewing its performance management system to ensure that the performance measures are aligned with strategic priorities such as product quality, delivery reliability, operational efficiency, and sustainability. Strategic priorities are aligned with other strategic priorities. What are the priorities? Quality, delivery, reliability, operational efficiency, and sustainability. Okay. The draft operating results for the year ended 31st December 2025 are summarized below. 31st December 2025 are summarized below. Okay. Division A, sales revenue. Division A, rupees millions 820 and 1260. Variable cost 360 and 650. Contribution 460, 610. Fixed overheads including depreciation 240, 360. Divisional operational profit 220, 250. Division A and Division B. Additional information. Depreciation included in fixed overheads. Division A, 80 million. 80 million is included in the fixed overheads, including depreciation, it says fixed overheads. 20% relates to head office assets. Okay, 20% relates to head office assets. So that may not be relevant for the division. Division B, 150 million, 20% relates to head office asset. Okay. Opening and closing controllable net assets. Division A, 800 million opening, 736 closing. Division B, 1700 million opening, 1680 million closing. Division B has invested 100 million at the start of the year. Division A made no new investment. So Division B has made an investment also, because investment decision making autonomy is there with the managers. These are investment centers. In addition to the depreciation, fixed overheads include head office expenses, which are equivalent to 2% of each division's revenue. So head office expenses also you can remove from that fixed overheads, because those are not controllable costs. Cost of capital is 20%. Taxation to be ignored. Again, tax adjustment not coming in. Good. But be mindful, you might get a tax adjustment at least in one sum this time, right? You are working as the corporate management accountant of AMPL and have been asked to conduct an analysis. Identify with justification the type of responsibility center appropriate for each division. Type of responsibility center, either profit center, cost center, investment center, what? Right? So you can say part A, the answer is both division A and B are investment center. Why? The question clearly says, okay, question, managers are responsible for divisions operate autonomously, managers responsible for pricing, cost, operation, and investment decisions. So these are clearly investment centers. Part A you can write down, no need to waste time. Both A and B are investment centers. An investment center is a responsibility center where division manager has control over revenues, costs, and investment in assets. And performance is evaluated using measures such as ROI and RI. That's it. Right? So it's the investment centers. You justify that managers have the control over revenue, costs, the profits, and the investments in assets. Okay. I don't want to waste your time. That's why I'm quickly giving the answer. Part B, conduct A performance appraisal for each division based on ROI with the set target. Okay, ROI. Conduct a performance appraisal for both divisions based on ROI, return on investment. Okay, we'll do that. ROI or return on investment is equal to controllable profit, the divisional profit or the controllable profit divided by average net assets. Average net assets into 100. Okay. Now the average net assets are there. First of all, we'll get the the costs and revenues are given. No? The costs and revenues are given here. The costs and revenues are given, right? So you get the sales revenue, variable cost, contribution, fixed overheads, including depreciation, whatever unwanted stuff we will remove. The profit is calculated, the easiest way is don't need to go back to all these things. You adjust the fixed overhead part, you adjust. The divisional operating profit is there. Divisional operating profit is there. Okay. So we'll say division A and division B. Okay. Right. Operating profit was given. Operating profit was given. For division A, as per the table given in the question, is 220, division B 250. 220 and 250. Okay. So on a similar manner, so whatever including the fixed overheads, whatever unwanted, we'll add back. Head office, right? Add back, you get head office asset depreciation. Head office assets depreciation. Okay, how do you get that? Now they say division A, you have a depreciation 80 million, out of which 20% relevant for head office. So that is like 80, these are in rupees millions, all are in rupees millions. All are in rupees millions. Rupees millions, both figures. 80 million into 20%. 80 million into 20%. 80 into 20, 16. Okay. 150 million into 20%. 150 million into 20%. 150 million into 20%. 150 million into 20%, 30. 150 million into 20%, 30. Okay. And also they say, in addition to the depreciation, fixed overheads include head office expenses which are equal to 2% of the division's revenue. 2% of the division's revenue. Head office expenses, that also you add back because that should not be a part of the fixed overheads relevant. I mean, those are not part of controllable costs of division. Head office expenses, head office expenses relevant for include head office expenses equal to 2% of division. Like those are head office related ones, so not for the division, not applicable for the division. You remove irrelevant costs, you remove, so your profits will go up. So sales revenue 820 into 2%, 2% on the revenue, 820 into 2%, and 1260 into 2%. 1216 to 2%. Okay. 820 into 2%. 16.4. 16.4. 1216 to 2%. 25.2. So when you add back those two, the blue colored figures, others I put red colored figures, the working, just to save the time here itself, the controllable profits. Controllable profit, okay, 220 plus 16 plus 16.4, 252.4, 250 plus 30 plus 25.2, 305.2, 305.2. Okay, 305.2, the controllable. And you need to get the average net assets. Average net assets, if you go this, if we continue with this, right? Average net assets you need to find out. Average net assets. Sorry. At the beginning of the year, they say, here they have mentioned, at the beginning of the year, division A, 800, end of the year, closing 700. Controllable net assets, average controllable net assets, division B, 1,700 million opening, 1,680 closing, and they have invested in 100 also. We'll see where that can be adjusted, okay, if it is to be adjusted, right? So 800 and 736 here, average controllable net assets. Average controllable net assets are required. 800 plus 736 divided by 2. That is 1536 divided by 2. 768 million. 760. Okay, million is not required anyway. On the top we put it's rupees millions, no? So then on the other hand, now for the division B, opening value is 1,700, closing value is 1,680. This is the controllable net assets. Even though they say they have invested, so that should have added, but there might have been some depreciation and they have the controllable net assets 1,680. So we can't incorporate the 100, the 1,700 you had. Let's say you added another 100. Then there was a depreciation. So finally the net asset is 1,680. So that's the figure I think we'll have to go by. Okay. So 1,700 plus 1,600. So that 100 investment is a kind of given to mislead. We add that also, but this is net asset given 1,680. So after depreciation. So head office part is removed because it says controllable net asset, not the head office assets. Okay. So 1,700 plus 1,680, answer divided by 2, it will be 1,690. So this is the figure that should be divided by the figure here. We get the ROI. ROI equals controllable profit divided by controllable average asset into 100. Controllable profit divided by controllable average asset into 100. Okay. So 252.4 divided by 768 into 100. 32.86%, 32.86%, 305.2 divided by 1690 into 100, 18.06, 18.05 or 06 rounded up to 06 we'll get. Return on investment 32.86 here, 18.06 here. Okay, right. So what was our question? Conduct a performance appraisal of institution based on ROI with the set target. Okay, ROI. What's the set target have they mentioned? A target ROI of 30% has been set. So division A is achieving more than that. Division A has achieved more than that compared to the 30%. Division B has not achieved up to that level. Critically discuss the dysfunctional behavior of ROI. What is the dysfunctional behavior of ROI? Now, return on investment or ROI is a widely used measure for divisional performance, but relying solely on ROI can create a dysfunctional effect. What is that? Short term, it's decision bias. Managers may focus on decisions to maximize the current ROI. They might look at however we'll try to go up to 30%, whatever the way. Example, rejecting a positive NPV project, it would temporarily reduce divisional ROI even though it adds value to the company. Now, positive NPV means always there's a value addition. But you don't take it up because it's like, maybe the IRR or maybe like it's temporarily reducing your return on investment. You are right now earning 32. You get a project with IRR of 25%, positive NP, yes, it's add value, but if you accept it, your ROI will come down. Therefore, you ignore it. But it's bad for the company. That's a dysfunctional decision. Okay. Investment rejection, ROI measures relative performance. ROI measures relative performance. If a division already has a higher return on investment, managers may avoid investing in projects with returns above the company cost of capital, but below the divisional ROI, limiting the growth of strategic investment. So that's another version of the same thing. Company cost of capital is 20%, divisional ROI is 32.86. So we have to set a target ROI 30% means it's always misleading, right? Because the company cost of capital is it given here? Yes, it's given 20%. Now let's say again the same point I have to elaborate. If we get a project with NPV 25% or like IRR 25%, that's better than company cost of capital. But division A manager would not select it because if he selects it, it will go down. I mean, his 32.33% will go down by some percentage. It might not come down to 25, but somewhere it will go down. So he doesn't want that to happen. So what he does is he ignores that project. But actually, if we had accepted, if we can invest and if we had accepted, yes, then we would have added value to the company. Now, how division A may be maintaining ROI, they haven't gone for new investment, it says. So this may be one reason. They don't want to bring down their ROI. So that's a dysfunctional effect. Good for the division, bad for the company. Not in the goal congruence concept. Manipulation of controllable costs or assets. Managers may delay maintenance, reduce necessary expenditure, or underinvest in assets. Delay maintenance. So those are like manipulation. Essential repair and maintenance. Yeah, you don't do that because just to save your profitability. You don't want to incur that expense. Reduce necessary expenditure. Unnecessary expenditure, it's okay. Necessary expenditure also you don't incur. So that your cash flow looks better and profits look better. Under invest in asset. You can invest, but you are investing lower portion. Shares or partial investments or whatever, you take only a lower portion to inflate ROI, which could harm the long-term operational efficiency. Right? Conflict with corporate objectives. Sometimes ROI focus can create misalignment between divisional and corporate goals. So we already discussed it. I don't know, certain points are repeated. Divisional goals and company goals can be different. So there can be a conflict. Managers prioritize divisional ROI. Focus on accounting measures over economic value. This is on controllable average net sales, controllable profit and depreciation removed and all these things. It's on accounting measures, not on economic value. While ROI is simple and easy to understand, its sole use as a performance metric can lead to short-termism, underinvestment, and decisions that conflict with overall corporate strategy. Companies often complement ROI with residual income or EVA, economic value added, to encourage value maximizing behavior. So don't take ROI alone, get RI or EVA also included so that you have a comprehensive evaluation. Analyze the performance of each division based on RI. So we'll go for that. Part D. Part C, the answer I gave verbal. You can refer to suggested solutions also, but certain points are repeated. That's what I highlighted. It's between the division and the company, the dysfunctional effect, conflict with corporate objectives, investment rejection can happen just to safeguard your ROI. Manipulation of controllable costs and assets. You don't want to take wanted expenditure, necessary expenditure, delay maintenance kind of things, under investments, those kind of things, right? So just 6 marks. So critically discuss the behavior, right? Residual income computation. How do you get the residual income? Residual income or RI or RI. RI. Analyze the performance of each division based on residual income. Residual value you get controllable profit minus capital charge of average net assets. I will explain it. It's a bit tricky, but you have to remember. It's not a percentage, it's an absolute value, rupee value. So we'll get the division A and division B. Now earlier we calculated the controllable profits. Controllable profits we calculated, so no need to repeat, you can copy down the figure. Okay. Controllable profit is 252.4 and 305.2. $252.4 and 305.2. Right. This is like capital charge, or in other words, you can say cost of capital. Cost of capital of average net assets. That way also you can say cost of capital of average net assets. Cost, so I'll say first of all, average net assets we have. No? Average net assets, that also we found 768 and 1690. Yes, 768 and 1000. Oh, no need to do it like this. We'll just do it in this way. Why do we waste our time? For division A, the RI, yeah, so it's one way that you can understand. That simply you can get. For division A, the RI equals controllable profit is 252.4. Average net assets was 768. Cost of capital on that is 20%. Cost of capital is given 20%. 20% on average net. The capital charge of net assets or cost of capital of net assets, the cost of capital rate is given 20% per annum. That into average net assets. Okay. So how much you get? 768 into 0.2. 252.4 minus 153.6. 252.4 minus answer is 98.8 millions of rupees is the residual income for division A. Division B, the residual income is, okay, the controllable profit is 305.2. 305.2. Average net asset is 1690. 1690 into 20%. 1690 into 20%. 1690 into 20%. 1690 into 20%. Okay. 338. 305.2 minus 338. So it's a negative value we are getting. 305.2 minus 338 minus rupees 332.8 million. It's a RI is a negative value, 32.8 million. It's a negative value, right? Negative value, 32.8 million. So residual income wise also division A is better, because I think what we get is our expected rate of return is 20%, but ROI actually generates only 18% in the division B. So they are not doing that well, even though they have a positive ROI. But we have invested in 100 million also, we don't know what has happened there. But here residual income actually gives you an absolute figure where out of your controllable profit, when you remove the cost of capital, that is the investment from the head office. On the controllable assets, you remove the head office assets, whatever the expenditure, head office, whatever the depreciation and all, then on the controllable assets, what is the cost of capital for the company as an investment? Are they generating profits better than that? So they are generating 98 point ahead, 98.8 ahead, division A. But here, generated operating profit is, controllable profit is lower than the investment cost. So its residual income is negative. Explain two advantages and disadvantages of using RI as a measure of divisional performance. Advantages and disadvantages of RI. Okay. You see, this is a very good but an easy question if you answer. Advantages of RI. Okay. Encourages value creation. Encourages value creation, business value creation. If you have a positive RI, means the business value is going up. RI measures profit in excess of a required return on investment or cost of capital, encouraging managers to accept projects that add value even if they slightly reduce divisional ROI. RI measures profit in excess of a required return on investment or cost of capital, encouraging managers to accept projects that add value even if they slightly reduce the divisional ROI. So, like divisional ROI may go down. Now, if you go by RI, a project with 25% IRR would be accepted by division A even though it's lower than their ROI, because the company cost of capital compared to the company cost of capital, the overall IRR of the project is better and it's adding value to the company. Reduces dysfunctional behavior. Unlike ROI, reduces dysfunctional behavior. Reduces dysfunctional behavior. So, like these kind of decisions were good for the company but bad for the division, we may not take, or good for the division but bad for the company, we may not take. Unlike ROI, which may discourage investment that is lower than ROI, RI focuses on absolute contribution over the cost of capital. Cost of capital එකට වඩා වැඩි නම් ගන්නවා. Over the cost of capital, if there's an absolute contribution, they accept it. Reducing short-termism, promoting long-term strategic decisions, which is important. Alignment with corporate objectives. So only 2 is needed. 4 marks though. Alignment with corporate objectives. Alignment with corporate objectives. Right, that is also going in line with the corporate thinking, corporate strategy as well. RI explicitly incorporates the company's cost of capital, aligning divisional decisions with overall corporate financial goals. Aligning divisional decisions with overall corporate financial goals. Aligning divisional decisions with overall corporate financial goals. Reward the performance beyond minimum expectation. Reward for performance beyond minimum expectation. That is, managers are rewarded for generating profits above the minimum required return, motivating higher performance. Managers are rewarded. Managers and divisions are rewarded. Managers and divisions are rewarded for profits generated above the minimum required rate of return. So it's almost the same thing we are telling in different ways. So only 2 points are enough. Okay, about the minimum required rate of return is 20% cost of capital. If you are generating profits more than that, you are rewarded. Not a target ROI. Disadvantages. Okay, disadvantages of RI. Disadvantages of RI. Absolute measure may be biased against smaller divisions. Biased against smaller. Absolute measure can be biased. Absolute measure or KPI can be biased against smaller division because it's an absolute. Now ROI compared to the investment, the value, asset value, controllable asset value, profit, the percentage. A division with 100 million investment and a division with 10 million investment. 10 million investment division generating a 6 million profit, 60% ROI. 100 million one generating 40 million, 40% ROI. But absolute value, when you go minus controllable assets into cost of capital, 100 billion division may be higher, but 10 million one can't be never higher because it's small. So smaller division, it may be disadvantageous against smaller division. That's why we need to consider both because it's an absolute value. Larger divisions are more likely to generate higher RI simply due to the size, which may disadvantage smaller divisions even if their efficiency is high. That's bad for the smaller divisions. Requires accurate cost of capital. This is depending on requires accurate cost of capital. Otherwise, everything is a mess. Requires accurate cost of capital. Correct cost of capital is required because this formula is totally depending on the cost of capital. If this is wrong, entire thing is wrong. But if you take ROI, it's not depending on the cost of capital. Okay. Complexity in calculation, it's a bit complicated, that you can say. Not so. Now, ROI is simple. You get the controllable profit, you get the average net assets, and you just compare percentage. Complicated in calculation, that can be a bit of a disadvantage. Only two you need to write down. Less intuitive than ROI. Less intuitive than ROI. What is that? Less intuitive than ROI. Managers and stakeholders may find ROI easier to understand and communicate, whereas RI may be less immediate interpret. So complexity in calculation, complexity in understanding. Complexity in understanding by managers and staff. Right? Understand and communicate, whereas RI may be less immediately interpretable. So those are some of the disadvantages you need to write down. So we have covered all the questions out of the pilot paper, and I wish all of you all the best for the exam. But only thing, please remember, please go through other revision questions that we have done. There can be slightly difficult questions than what is given in the pilot paper. So we never know. So don't just expect certain elements are very easy in the pilot paper. Don't expect the same. But theoretical aspects can be similar. Calculations can be even made a bit difficult. So you never know. Just be prepared for slightly tougher than this. But anyway, go through these areas, look at the weightage and all. And based on that, you give your emphasis. And within this week, put your best effort and come up with the flying colors. So I'm sure you can do it. Give your best so that you can pass this hurdle. All the best to all of you.